onto control share tonight. Trust we have a lovely midweek. Oh, it's even Tuesday. My lecture is always between Wednesday and Friday and Thursday. All right, we move to the classroom. Yeah, Mr. Jubri, good evening. Trust you are doing great. Now let's go to the business of the day. We are looking at capital reconstruction and business reorganization. We have been on this topic since last week. Of course, we have explained the basis or the theories of this topic. Capital reconstruction is a major reorganization of a company's capital structure. It is usually undertaken when a company is experiencing financial difficulties and the possibility that the company will collapse is very high. We mentioned that reconstruction might involve revaluation of assets, introduction of additional capital to the business, conversion of debt capital to equity, conversion of equity from one form to another form of equity. Existing shareholders may be required to relinquish parts or all their shareholding and accept a smaller quantity of shares in the reconstructed company. We explained that reconstruction is worth considering if that reconstruction is beneficial to parties involved. Let me repeat that point. We are going to be talking of reconstruction, provided that reconstruction is beneficial to the parties involved. Reconstruction will be beneficial if it results in getting more cash or getting more value from the reconstruction than liquidation of the company. We explained the steps involved in reconstruction. We have 6 steps. You are going to bear in mind the principle of capital reconstruction. What are these principles? One is reconstruction must not make creditors worse off. Reconstruction must not make the creditors worse off. 2 is the principle of post-reconstruction financial profitability. If we reconstruct a company, there must be a possibility that that company can return back to profits. Then, number 3, reconstruction should be fair to all parties. You must bear in mind this principle. Step number 2, consider situation in liquidation. If that company is liquidated and the asset realized, who gets what? It means that if the company is liquidated and the asset disposed, how would the proceed from the disposed asset be distributed? We emphasize that you cannot use your personal initiative to distribute the proceed. The law specifies how the proceed should be distributed. The proceed will be distributed in this order. Preferential creditors, we collect. Who are the preferential creditors? We have unpaid wages and salaries, unpaid pensions, unpaid taxes. Then we have fixed charge secure creditors, floating charge secure creditors, excuse me, redundancy payments, unsecured creditors, preference shareholders, and ordinary shareholders. And we explained that when it comes to fixed charge and preferential creditors, there could be conflicts. Any asset used as a fixed charge must be applied to the fixed charge. Assets used for fixed charge cannot be given to preferential creditors. Then we look at step 2, that there should be cash adequacy. There must be sufficient cash to implement the reconstruction scheme. So you are going to compare cash required for implementation of reconstruction with cash available. Step 4, you are going to test for post-reconstruction financial profitability. Step 5, you are going to evaluate the extent to which the reconstruction is fair. You are going to evaluate the fairness of the reconstruction scheme. Then step number 6, you are going to draw a conclusion. We explained this and we solved a question the last time. Tonight, we are going to take one more question to round up this topic. All right. Before we move to the question, illustration 2. Any question, please? From what we solved last time, any question? Any question, please? All right, please allow me 1 minute. Please 1 minute. All right, let's go on with the class, please. All right, I can assume that there is no question between the last time we met on Thursday and now. All right. Let us look at illustration 2. Illustration 2, I'll read. Able Bank on April 24, 2019, received the following statement of financial position prepared for its customer, Pecon Limited. Statement of financial position as at April 20th, 2019. Let us go through the statement together. Freehold property, 20 million. Plants, 172 million. Total non-current assets, 192 million. Current assets, inventory, 67 million. Receivable, 26 million. Total current assets, 93 million. The total assets of the business, 285 million. Equity, issue share capital, ₦1 each, 50 million. Reserves, 23 million. Total shareholders funds, 73 million. Non-current liabilities, 10% loan note secured on freehold property. Please asterisk if it is possible. 10% loan note is secured on freehold property. The loan note is 50 million. This is a fixed charge where a liability is secured on a particular asset of a company. This is fixed charge. If you're in exam, as you read question, you also pay attention to certain information that will impact on your calculation. All right. Current liability, bank overdraft, sundry payables. Current liability, we have bank overdraft 45 million, sundry payables 117 million. Total liability plus shareholders funds, we have 285 million. You continue. Okay, that's fine. PL. As PL is a long established company which has traded, is a long established company which has traded profitably until a few years ago. Following the expiration of exclusive patent rights on a particularly profitable product line, results declined dramatically. Over the last 12 months, the company's cash flow problem have steadily increased. The overdraft facility at present stands at 45 million and carries a second charge on the company's freehold property. Let's explain that briefly. In this question, two liabilities are secured on the same asset. Loan notes, please note, loan notes is just like your debentures or like your bond or your loan stock. Now that loan note is a liability secured on freehold property. Examiner now says overdraft facility at present stand at 45 million and carries a second charge on the company's freehold property. Again, overdraft facility is secured on freehold property, but it's a second charge. That means the 10% loan note will carry the first charge, while bank overdraft will carry the second charge. Two liabilities are secured on the same assets. It's also a fixed charge, but one liability will come first before the second liability. All right. A meeting has been arranged to consider the company's future. The above statement of financial position will be presented at the meeting, and the following proposals will be discussed. Proposal A, immediate liquidation of the company. In this circumstance, it is estimated that freehold property will realize 65 million, plants will realize 21 million, inventory will realize 40 million, and the receivable will pay up in full. Preferential payables included in the statement of financial position figures for payables amounted to 27 million. Proposal B, Tire Limited has made an offer to take over the entire business activities of PL. Under the terms of the offer, Able Bank will receive 80% of the balance due, but repayment will not be made until exactly 1 year from the date of the creditors' meeting. No further interest will be considered to accrue on the balance due to Able Bank during the 12-month period. Proposal C, reorganization and capital reconstruction. The management of PL is planning a reorganization of the company's activities, which will restore profitability to reasonable levels almost immediately. The reorganization will be linked with a capital reconstruction scheme. Under this scheme, the existing shareholders will be asked to accept 2 1 shares in exchange for every 5 shares currently held. The bank will be asked to accept 10 million 1 share as consideration for 1/2 of the present overdraft. If this proposal is acceptable to creditors, the shareholders have indicated their willingness to take up a further 30 million 1 shares for cash, and the balance remaining outstanding to the bank will be repaid from the proceeds of this issue. The directors are confident that if this proposal is put into effect, profit of 40.5 million naira per annum will be earned for the foreseeable future, of which 2/3 will be paid out as dividends and the remainder reinvested. Note, assume that the bank earns 15% on all its lendings, and the amount in the statement of financial position include interest that accrue to date. Assume for convenience that any adopted proposal will be implemented immediately, with payment received immediately, unless otherwise stated. Ignore expenses of realization and liquidation, and assume that no changes have occurred between April 20th and 24, 2019. Requirement A, calculate the amount which Able Bank will receive under each of the three proposals, 10 marks. Let us deal with A first. Now, please, like I usually ask, to what extent do we understand this question and the examiner requirements? What are we expected to do? Yes, please. To what extent do you understand this requirement? The class is silent.
Is it in relation to the question that is asked, or just our general appraisal of what's the case that is before us? Because what I can see here is they presented a company to us. They presented the balance sheet to us, and they are giving us three options for the company to rescue themselves. One is whether they should liquidate. The second is based on the offer by somebody else. And the third is if they embark on a capital reconstruction. So we're supposed to appraise the three options and now start, now advise on which is best for the company along the lines of the questions that this particular, what is required in the question. I think that is what is before us.
Thank you, sir. I think you did a good summary. At least, thank you so much, sir, for that. Now, you made a good point, but I need to chip in some area here. We have a company that has obtained overdraft from a bank. The company's name is Pecon Limited. This company obtained overdraft from Able Bank. Currently, this company is experiencing financial difficulties. And three proposals has been put forward. First is liquidate the company. Second is the company should be taken over by Tayo Limited. Third is reconstruct the company. Now the question is, under each of these proposals, what will the bank receive? The question is about a single stakeholder, the bank. Unlike the question we solved the last time, we dealt with three stakeholders. We dealt with shareholders, secured debentures holder, and bank. This question is specifically concerned about what bank will receive. If this company is liquidated and the assets realized, how much will Able Bank be able to get? That is proposal 1. Proposal 2, if this company is taken over, look at it. Tayo Limited has made an offer to take over. If this company is taken over by Tayo Limited, what will Able Bank receive? Proposal 3, If this company is reconstructed and reorganized as proposed by the directors, what will Able Bank benefit? I always try to explain question before solution. My take is, if you understand the question and requirement, it's much easier for students to relate to it. Now we now go to solution. Our attention is simply on Able Bank. All right. Thank you, sir, for the explanation. I want to be sure that we are on the same page. So we move to the working board. Move to the working board. Just 1 minute. Pause. Please confirm you can see my whiteboard being shared. Where is GD? I didn't see GD today. Is he online?
I'm here, sir. Good evening,
Please,
sir.
kindly. Oh, Jide.
Good evening, sir.
I didn't want to worry you. Just let me read my question today. Let me allow you rest.
Thank you, sir. Thank you, sir.
All right, please confirm you can see my screen being shared.
Yes, sir. We can see your screen.
Okay, great. All right, we'll now move to the solution together on the whiteboard, even though it's available on the material share. To enhance understanding, we are also going to take solution here. Okay. My first working, we start with proposal 1. Our first working, proposal A. Proposal A. That is liquidation of the company. Liquidation. Now, if this company is liquidated, how much can we realize from the asset? Let's go to it together. Look at it, please. If the company is liquidated, it is estimated that freehold property will realize 65 million. Please note that plants will realize 21 million, inventory 40 million, and receivables will pay up in full. Let's go back to the board. I'll come here. Realization. Naira. Plants, how much, please? 21 million. Inventory, how much, please? The car is silent. Inventory, I think 40 million.
40 million.
Yes, please. That gave me assurance that people are listening to me. Receivables will pay up in full. Please check the statement. What is the receivable value?
26 million.
Thank you. 26 million.
6 million.
Thank you. 26 million. Totaling how much, please? Let's sum up.
It's 7 million.
87 million. Oh, you are in traffic. You are on traffic. Sorry, it shall pay off. Now you observe that I didn't add property to this list. Why?
It's secured on another.
A fixed charge. Thank you. Total realization. Deliberately, we didn't pick freehold property 65 million because it's having a fixed charge. That asset has been used as collateral for two liabilities. In the event that the company is liquidated, any money realized from that asset must be applied directly to the liability or liabilities tied to it. Is that point clear, please?
Yes, sir.
Thank you. I will now come here. I'll now bring in, let's look at it. I'll come here, freehold property. We are going to get 65 million. This proceed must be applied to the liability tied to it. We have two liabilities tied to this. Let's go and check it together. Please look at it. Yeah, look at it, please. 10% loan note secured on freehold property. The value of the loan note is 50 million. That means the money realized from freehold property will be applied first to settle loan notes. And we also come here. Look at the note here also. The overdraft facility at present stands at 45 million and carries a second charge on the company's freehold property. After we have settled the liability of loan notes, any balance remaining will be applied to settle bank overdraft, if there is any. I cannot come here. I'll come here, the first charge. First charge. That is our loan notes. Loan notes. That is 50 million. Out of 65 million, we settle 50 million. We are left with what, please? We are left with 15 million. Is that not, please? Then this 15 million balance, I can come here, the balance 15 million, the balance 15 million will now be used to settle bank overdraft. Bank overdraft carries second charge. I will now come here. Bank overdraft. I've shortened this. Overdraft was 45 million, but we only have 15 million remaining. Is that not, please? That means outstanding overdraft. Outstanding overdraft overdraft is 30 million. Able Bank has given overdraft of 45 million. The bank can claim 15 million from freehold property. Then we have balance of 30 million. Now the question is, how would the bank claim this 30 million? Hello? How would the bank claim this 30 million?
The bank will rank alongside other unsecured creditors to claim the outstanding balance.
Thank you. Able Bank will rank alongside other unsecured creditors to claim the balance of 30 million. We are going to put this remark or this note in your calculation. I will now come here and put a remark. Bank we rank alongside other unsecured creditors. Unsecured creditors to claim balance of 30 million. If you look at it, we have distributed, we have taken care of this charge. The company is going to be liquidated. Assets realized. The order of distribution, we have settled fees charge. We are now left with 87 million. We are left with what? 87 million to be distributed to other stakeholders. We are left with this now. Please now look at the order of distribution. Who collects? Preferential creditors. Out of this 87 million, now go check the question. Do we have preferential creditors? Look at the question, please. Look at my highlighted. Can you see my question being shared, please? Hello?
Yes, sir.
Now look at the highlighted. Preferential payables included in the statement of financial figures. Statement of financial position figures for payables amounted to 27 million. Please note, preferential payables are also called preferential creditors. That means we have preferential creditors. Then we must settle them. We have settled fees charge because that asset is fees to it. We now have to settle preferential creditors. Out of 87 million, we are going to pay 27 million for preferential payables. Let's go back to our board, our whiteboard. Okay, I'll allow this to fly. Let me open another board, allow this to fly. Look at this, please. I'm sure you can see this screen being shared. We continue. Now we have realization. I have, please, I just want to shorten it, 87 million. Then I will now come here. I will set to preferential. The preferential payables. This is 27 million. We are left with what, please? Oh.
$60 million.
We are left with 60 million. $27 million. Then we are left with 60 million. Now, we have settled preferential creditors. We have settled fixed charge secure creditors. Next is floating charge. Floating charge secure creditors. If you look at the question, we don't have floating charge. After floating charge, then we have redundancy payments. If you look at the question we are dealing with, there is no redundancy payment. Then we now have unsecured creditors. I will now come here. I'll come here. Total unsecured creditors are. Now let's go to the question. Let us go and list out unsecured creditors. Just go and check your current liability. We have balance of bank overdraft. And we have sundries, sundry payables. Now the sundry payables is total is 117. But the examiner says, look at the note here. Preferential payables included in the statement of financial position figure for payables amounted to 27 million. That means out of that 117 million, 27 million is for preferential payables, and we have settled this. So we are now going to look for the balance of sundry payables and the balance of bank overdraft. If I come here now, I'll come here. One, outstanding bank overdraft. That will be claimed as unsecured. That is 30 million. Then other sundry payables. I'll put in bracket, out of 117 minus 27 preferential payables, that was included. That means I have 90 million, everything in million. Therefore, total unsecured creditors, 120 million. Look at it. We have net cash, 60 million. You want to settle 120 million. Can you go round? Hello?
No.
it can't go round. That means we are going to prorate. The unsecured payables total is 120 million. And our net realized cash is 60 million. Definitely this cannot go round. I will now distribute. Can come here and say, look at it, please. You now come here. From here, I can say share of net cash. That means bank will get 30 over 120 multiplied by 60. 30 over 120 multiplied by 60. Please compute. Bank will get 15 million. Other sundry payables. Other sundry payables. We get 90 over 120 multiplied by 60. That's 45 million. Totaling 60 million. We have finished sharing money. Now, if the company is liquidated, what will Able Bank get in total? Remember that if you look at this first working, or why? If you look at this, Able Bank has gotten 15 million here. Part share from property. Then Able Bank will also get 15 million share as unsecured creditors. Sorry.
Thank you.
So in total, Able Bank will get one from property. It will get 15 million. Two, as unsecured creditor, as unsecured creditor, Able Bank will also get 15 million. Totaling how much, please? Totaling
audio people for don't did answer. See if I know, I just get that log. Now, mommy will say,
"Now me ginger you." Say na Jane will be the next thing, when they go begin to now. Now people when know.
Please mute.
Utomi, please mute. I'm conflicting my class, so.
I'm sorry, sir.
I'm sure it's not aware that it's conflicting my class. So if that company is liquidated, bank will get 30 million naira. We are done with proposal 1, proposal A. Any question? If the company is liquidated, bank will get 30 million naira immediately.
So I have a question. I don't understand how you got million, please. Can you come again?
How we got what?
this 30 million, like this 15 from properties and unsecured creditors, 15. Like,
Were
I
you
don't know
with us
how.
at the start? Were you with us at the start of the class?
Yes, yes. It's just this part I don't understand.
Okay. Now look at this part. Up to this point, look at it. Total unsecured creditors. Outstanding bank overdraft, 30 million. Can you see that?
Yes.
Other sundry payables, 90 million. Do you understand how we got this also?
Yes.
So total unsecured payables, 120 million. Is that clear?
Yes, sir.
Now, we only have 60 million for distribution. Is that point okay?
Yes.
We now want to share 60 million between two parties. And the total liability is 120 million. That means this 60 million is not sufficient. We need to prorate it. We now got to share of net cash. Look at the net cash, 60 million. Bank, that is outstanding bank overdraft. Bank has 30 million over total 120 million multiplied by 60 million. That means bank will get 15 million here. Are you there, please?
Yes, sir. I'm sure.
Other sundry payables, 90 million over 120 multiplied by 60 million. Other sundry payables get 45 million. That means from this aspect, bank will get 15 million. Is that one clear?
Yes.
So that was note number 2. Look at it. Able Bank will get as unsecured creditors. Able Bank will get 15 million. As an unsecured creditor, Able Bank will get 15 million. Is that taking place?
Yes.
Good.
Sir.
Don't worry. We are not done. We now move to the first page. Look at this page. We have, trying to bring this down. Yeah. Now, Able Bank has given an overdraft of 45 million to a company. The company is in financial crisis and cannot pay back. The company is now looking at 3 proposals. One of them is liquidation of the company. Now, if the company is liquidated, the asset can realize as follows. Now, one of the property to be realized is, one of the assets to be realized is freehold property. Let me take you back to that question quickly. Look at the question. It is estimated that freehold property will realize 65 million. Keep in view. Examiner says from the question, look at the question. We have non-current liabilities, 10% loan note secured on freehold property. This is a fixed charge. In the event that the company is liquidated, any money realized from that property must be applied to settle the liability. So this loan note, 50 million, is secured on freehold property. Let's continue. The question also says the overdraft facility at present stands at 45 million and carries a second charge on the company's freehold property. I was trying to explain this at the start of the question. Two liabilities. Loan note is a liability. Bank overdraft is a liability. Both liability are secured on freehold property. But loan note carries first charge, while overdraft carries second charge. In the event that the company is liquidated and the asset realized, the proceeds from the asset will be applied to settle loan notes first. Then any balance remaining will be applied to overdraft. Now let's go back to that working now. Look at the proceeds. Freehold property realized 65 million. Out of this 65 million, first charge, loan note, we settle 50 million. We are left with 15 million. We have realized 65 million. We settle the first liability, loan notes, 50 million. We are left with 15 million. Then the 15 million will be applied. Second charge now, overdraft facility. The 15 million is applied to overdraft. Out of 45 million, we settle overdraft for 15 million. We now have outstanding overdraft of 30 million. Is that point clear, please?
Yes, sir. I get it now. Thank you.
Is that point?
Yes, it's clear.
Okay. So if you go back to that page 2, look at it. From property, Able Bank will get 15 million. As unsecured creditor, it will also get 15 million. Total amount Able Bank will receive if the company is liquidated is 30 million. I hope that point is settled.
Yes, it is. Thank you, sir.
I thank you for asking, because you also help others who might not get it very well. We move to proposal 2. Or proposal B. Let's look at it together. Please look at proposal B. Tayo Limited has made an offer to take over the entire business activities of PL. Under the terms of the offer, Able Bank will receive 80% of the balance due. The repayment will not be made until exactly 1 year from the date of the creditors' meeting. Okay? No further interest will be considered to accrue on the balance due to Able Bank during the 12-month period. So my question to the class is, what is the balance due to Able Bank? My question to the class is, we need to compute 80% of the balance due to Able Bank. What is the balance due to Able Bank? Oh yeah, oh. Okay, let me look at my, you can also send in your answer via chat. 30 million, that's wrong.
9 million.
9 million. How?
80% of 45 is 36.
No, okay,
So
I just ask you, what is the balance due?
Is 9
You are
million.
correct. The balance due to Able Bank is 45 million. We now compute 80% of 45 million. Please note, each proposal is treated independently. We call this mutually exclusive proposal. Proposal A is independent. You can either take A or B or C. So you have gotten the answer to say 80% of 45 million. So 36 million. But the balance due to Able Bank is 45 million. We now compute 80% of 45 million. The overdraft facility is 45 million. Able Bank has granted overdraft of 45 million. So please, each proposal will be taken independently. Why I'm asking this question, don't go and take 15 million as the balance deal. Proposal A, we have treated. Examiner says, determine amount Able Bank will collect under each of the proposal. The proposal will be treated individually. So let's move to it quickly because we still have a lot to worry about on this question. I'll come here. Proposal B. This is just one line. Proposal B. This is Tire Limited. Tire Limited take over 80% of 45 million. That will give us 36 million. 36 million to be received. To be received in 1 year's time. You need to put this note there. So if Able Bank accept proposal A, Able Bank will get 30 million immediately. If Able Bank accept proposal B, Able Bank will get 36 million in 1 year's time. Is that clear, please? We can now move to proposal C. Proposal C, this is capital reconstruction. All right, let's go to proposal C together. And you have moved so fast. Proposal C, reorganization and capital reconstruction. The management of PA is planning a reorganization of the company's activities, which will restore profitability to reasonable level almost immediately. The reorganization will be linked with the capital reconstruction scheme. Just 1 minute. Let's continue. The reorganization will be linked with the capital reconstruction scheme. Under this scheme, the existing shareholders will be asked to accept 2 1 naira shares in exchange for every 5 shares currently held. We need to treat this. You are going to accept 2 shares for every 5 shares currently owned. That means your share will reduce by 3. For every 5 shares, 3 will be reduced. So let's go and look at number of shares currently in existence. Look at it, please. Equity, issue share capital, 1 naira each, totaling 50,000. That means currently we have 50 million shares in existence. The examiner says we are not going to do 2 for 5. Shareholders will be asked to accept 2 shares for every 5 shares currently held. That means we are going to reduce their share. For every 5 shares you are having, we are going to give you 2 and collect 5 for you. So please calculate. Okay, let's go to the board. The shares will be reduced. Look at it, please. Let me see, somebody has done it. Yeah, thank you. We are now left with 20 million shares. Yeah, very correct. You just come here, do like this. Your share capital. The 50 million shares has been reduced. You have the quantity. You have the price. Then you have the value. This is price, please. So, existing share before, existing share, we have 50,000 shares. Nominal price is 1 naira. Value 50,000. Examiner says 2 for 5. We call it reclassified. Reclassified. 2 over 5 multiplied by 50. This year, you are going to have 20,000 shares. Please close this up. Don't add it to. This has been reduced. ₦1, thank you. We have the share that worth 50 million has been reduced to 20 million. We have done that working. Let's go back to our notes. Let's continue. The bank will be asked to accept 10 million 1 naira shares as consideration for 1/2 of the present overdraft. So, okay, bank has given the company overdraft. Overdraft is a debt. We are now converting the debt to ordinary shares. Conversion of debt to ordinary shares. But not all the debt. Look at it. the bank will be asked to accept 10 million, 1 naira share as consideration for 1/2 of the present overdraft. Please, what is 1/2? Let us interpret 1/2 out to ourselves. Yes, who is interpreting for us? What is 1/2? You can send in your answer. I didn't get that. 1 over 0.5. I didn't get that. What is 1/2? Yeah, 1/2 is simply half. 1/2. That is just half, 50%. Yeah, thank you. That is just half. Please, it is not 1/2. It is just 1/2. So 1/2 of the overdraft. The present overdraft is 45 million. Now compute half of it. That will give you 22.5 million. That 22.5 million overdraft will be converted to ordinary shares of 10 million. Let us go and do this. Effect this working. We come here, I'll just do simply Able Bank now. That is half of the overdraft, 45 million. Will be converted to shares that are worth 10 million. Nominal price 1 naira. 10 million. So the only thing remaining now is 50% of the overdraft to be repaid. All right, let's continue. If this proposal is acceptable to creditors, the shareholders have indicated their willingness to take up a further 30 million shares for cash. That means existing shareholder will subscribe for 30 million naira shares and bring in cash to the business. We can treat that quickly. I'll just come here. Issue of new shares. New shares. 30,000. Price 1 naira. Total 30 million. So I can close this up. This is 60,000. No, it's a million. This is also 60 million. Please note, Able Bank has 10 million out of 60 million shares. Please note, our concern is with Able Bank. If the company is reconstructed, the total share capital will have 60 million shares. Able Bank only has 10 million out of the 60 million. All right. We continue to push. I'm trying to make just 1 minute. That board is full. I want to see if I can still take one more white. That board is full. The board is full. Oh. Oh, I can only take 4 stars. Mm. Oh, okay. Just 1 minute. Let me save some of this thing and move out of here. This is second able. Well, I need to move this to the front. Able bank. Don't close. Close. Okay. Okay, I think you can share now. Okay. I can accommodate one more board now. Let's continue. All right, please confirm you can see the whiteboard being shared.
Yes, sir.
Okay. Remember our share capital. Out of 60 million, Able Bank has 10 million shares. Okay. Now let's continue. Okay. The shareholders have indicated their willingness to take up 30 million shares for cash, and the balance remaining outstanding to the bank will be repaid from the proceeds of this issue. What is the balance remaining outstanding to the bank?
$45 million.
22.5.
Thank you. Please, let's follow. The balance remaining is 22.5. We have converted half of it to ordinary shares. That means the balance remaining is just half. Out of 45 million, you converted 1/2 to ordinary shares. The remaining 1/2, that is the half, is 22.5 million. So Able Bank will receive cash immediately, 22.5 million. Please note that. Now, I'll continue the reading. The directors are confident that if this proposal is put into effect, profit of 40.5 million per annum will be earned for the foreseeable future, of which 2/3 will be paid out as dividends and the remainder reinvested. The directors are confident that if this proposal is put into effect, we are going to make profit of 40.5 million. Let's go to this. We now treat everything together. Let's go to this. Look at it. I'll come here. Profits. $40,500,000 to be achieved. Then dividends. Out of this profit, we are going to pay dividends. 2/3. Please compute 2/3 of 40,500,000 to get the dividend to be paid.
7 million.
How much, please?
27 million.
27.
Thank you. Thank you. I want to shorten this because of space. So 40.5 million. So dividend to be paid out is 27 million. Balance to be reinvested. That becomes retained earnings. Is that not? Or retained profits. Balance is 13,500,000. Now, out of this 27 million, how much will Able Bank get? Because Able Bank is now part of the shareholder. Look at it. Able Bank receive dividends You know, he has 10 million shares out of 60 million. So 10 over 60 multiplied by 27 million. How much will dividend going to Able Bank?
4,598,000.
No, 4,500,000. Check it out. There shouldn't be any 90. It should be round. Check it. Able Bank dividends will come in 1 year's time. Year one. We can do a summary now of all the three methods, of all the three proposals self. I hope we have reconfirmed that.
Yes, sir. 4.5.
4.5 million. We can do a summary of results. We can come here and say summary of result now. Summary of result. All the three results. I have proposal A, proposal B, and proposal C. I have cash now. Cash now. I have cash in year 1. Year 1. I have cash in subsequent years. Under proposal 1, every bank will get cash immediately, 30 million. Nothing in year 1, nothing in subsequent year. Under proposal 2, every bank will get nothing yet now, 36 million in year 1 and nothing in subsequent year. Under proposal C, every bank will get 22.5 million now. That is the balance remaining. Then it will get dividends in year 1, cash dividends, 4.5 million. In subsequent year, in as much as the company is in existence, then it will get dividend in subsequent year, because the bank is also part of the shareholder. Dividend in subsequent, in subsequent years. This is the answer to requirement A. If the company is liquidated, that is proposal 1, Able Bank will get 30 million naira immediately. Proposal 2, Tayo Limited offer. If Tayo Limited takes over the business, the bank will get 36 million in year 1. That's all. Proposal C, reorganization and capital reconstruction. If the business is reorganized and capital reconstruction is carried out, Able Bank will receive 22.5 million immediately. Then year 1 is going to get 4.5 million dividends, cash, and dividend in subsequent year. The profit is for foreseeable future. Dividend will be coming 4.5 every year for foreseeable future. This is the response to requirements A. Any question, please?
Yes, I have a question.
Please go ahead.
Okay, so we stop here, and I'm just wondering, so we don't discount to get the discounted value to have present value for this A and B, and even for C to have a better comparison, because the bank is earning 15% per annum on their loan. So that would have just been a it seems to be an appropriate discount rate to use to get the present value. Then for C, we will now say after the
One thing I
discount, we'll
can
now
say,
start talking about. Yeah. I'm just asking, I'm just curious, please.
no, it's good. One thing I get is you have an understanding of what we are doing. That we cannot just compare now, but this is requirement A. Examiner says, give me what they will get. This is requirement A. But your question is a confirmation of the fact that you know that we are not supposed to stop here now, because cash flow in year 0 is not like cash flow in year 1. So that question you raise is what is tested in B part of the question.
Okay, there's a B.
Yes. This is your A for 10 marks. If you any other question, if you want to move to part A. Okay, we still await question if there's any. Now, if you look at the part B, which is also for 10 marks, look at it. Examine the relative financial merits of the proposals from the viewpoint of Able Bank. I now want to look at the relative financial merits. Relatively, which one is better? Should I say proposal A or B or C? Definitely, for me to compare, I must bring all the cash flow to their present value. And that bank rate, look at it, assume the bank earns 15%. That is the return on bank's lending. That 15% is an appropriate discount rate. So like the last person said, for you to talk of the relative financial merit now, we are going to discount all the cash flow to their present value using the bank rate of 15%. We can now look at it comparatively. Which one is better? Is that clear, please? Okay. And save this. Trying to open another sheet for that purpose. Okay. So to examine the relative financial merits, first, you are going to determine the present value of each proposal cash flow. So come here now, our B parts. First, calculate present value of each proposal you come here, you have the year, the cash flow, the discount factor, and the present value. You pick proposal A, proposal A. This will happen in year 0 now. The cash flow is 30 million. Our discount factor is 15%, or discount rate 15%. In year 0, discount rate is 1, discount factor is 1. So the present value is also 30 million. You are done with proposal A. We move to proposal B. Proposal B. This will happen in year 1. The cash flow is 36 million. Please, 15% discount factor year 1. What do you have? Please check it out. This is a million. I think you should have 0.877. Please get the present value, 31.32 million, if I'm not mistaken. You can confirm it. Then we have settled this also. Then move to proposal C. Proposal C. I have year 0, 22.5 million. The discount factor is 1. This will give me 22. 22.5 million. I also have year 1 to infinity. Please remember that dividend is in perpetuity. In as much as the company is existing and the company is making profits, the bank will continue to collect dividend for foreseeable future. So 4.5 million. How do we calculate the present value of a cash flow to perpetuity? Yes, quickly. How do we calculate the present value of a cash flow to perpetuity? Is simply the cash flow divided by the discount rate. That is 1 over the discount rate. Our discount rate is 0.15. Please multiply 4.5 multiplied by 1 over 0.1 multiplied by 1 over 0.15. Please work it out. You should have 30 million. I'll wait your answer, but you should have 30 million.
6.67.
For simplicity, just do like this.
6.67.
If it's like this now, 4.5 million multiplied by 1 over 0.15, Abby. You simply say 4.5 divided by 0.15. You save yourself the stress. Yeah, Mohammed, thank you. Let me put this neatly so that somebody might not be in class, is looking at what we have done.
Discount factor.
So please, if you are to calculate the present value of a cash flow in year one to perpetuity, is simply the cash flow divided by the discount rate. Yeah, look at it. Cash flow divided by the discount rate. Ah, that's all. Voila. Our cash flow is 4.5 million. So I can simply say 4.5 million divided by 0.15. That will give you 30 million. So proposal C, the total present value is 52.5 million. You can now make your comparison now. Which one is better for Able Bank to do? Yes. Which one is better for Able Bank to do? Should I accept proposal A, or B, or C? We are done with the calculation. Just to comment and move out of this. So which one is better? Let me hear your view. What will your advice to the bank?
Based on the calculations we've done, proposal C is the best option because the bank can earn up to 52.5. But there's a caveat. This 4.5 to perpetuity, the assumption is that indeed the company will continue to pay this dividend. It's an assumption. So they can pay the first year, second, we don't even know whether it will cease. So that is the caveat. Otherwise, on the surface, proposal C appears to be the best option.
Sorry, who is speaking? Please, can I put a name to that voice, please? Yes, somebody else spoke. Who is the person? I can't hear again. Oh. Okay, Robbie.
Robbie.
Okay, yeah. Yeah, at least a demonstration of intelligence there. Look, I need to be careful here. Yeah. Any other opinion? Okay, I think Mohammed also says C. Okay, Opeyemi, my namesake, Bello, it also says C. Of course, if you are making a comment, so that let me take you back to the notes where we have the comments. Now look at the comment part. Proposal C offers the highest return, but it is perhaps the most risky option or the riskiest option. Proposal C offers the highest net present value of return, but it is the most risky option or the riskiest option. If the reconstruction phase, if the reconstructed company fails to make the expected profits, the bank will only receive 22.5 million. On the other hand, if the construction succeeds, the bank will make a good profit on its current overdraft investment. You can see the comment. That was why I said the way Robbie put it, where there is no guarantee that the profit will be achieved. So we need to take a caveat. Yes, it offers the highest present value, but it is the riskiest option, or the most risky option. If the construction company fails to achieve the profits, bank will only receive 22.5 million. But if the construction succeeds and the profit is achieved, bank will make a good profit out of its investment. Proposal B is marginally preferable to proposal A, although there must be some risk that Tayo Limited can default. Tayo Limited may default payments. Somebody promised to give you money in 1 year's time. It can fail now, it can default, nothing will happen. You are taking over a company and you promise to pay the creditor, one of the creditors, in 1 year's time. You're only going to make that payment if that company is doing well now. Then proposal C, proposal A is the least risky option and offer the lowest return. So we have explained. Our concluding part will be the choice between the three proposals will depend on the judgment of the management of Able Bank. The choice between the three proposals will depend on the judgment of the management of Able Bank, and in particular, an assessment of the degree of risk with each option. The extent to which the bank is willing to accept risk, they make their final decision. And that is the rounding off for the 10 marks. We are done with the question.